Moderating this session will be Professor Houston Kwa, Head of Division of Economics at the Nanyang Technological University, Singapore, and President of the Economies Society of Singapore. Professor Kwa, please.
Good morning, everyone. Well, I trust that this morning you have heard about the political trends, political issues. You know, as there's a saying, economics and politics go together. Sometimes, of course, some would argue that economics come first, but some would argue that we need political will to achieve things. But the two, must marry. So in this second session, we will talk about economic trends, and there's plenty happening in the world. Sometimes you look at economies, they are like our weather, Sometimes we have lots of sunshine and suddenly torrential rain and goes on for days and weeks and so on. And suddenly a break in the cloud and there's a sunshine coming back again. So sometimes we shouldn't be getting so perturbed about many things happening because the market has a way to solve a lot of these things. And if it doesn't, the governments would have a way as well to intervene and check by the private sector and so on and so forth. Now, there are lots of happening in the world, as I said. So in the United States, for example, we saw the approved tax cuts in the US. That's quite a lot. There's a bullish stock market. The infrastructure bill in the US is in force, and a renegotiation of some of the trade agreements. In China, we have the Belt and Road Initiative, opening up trade, opening up new areas, new cooperation. That's important for the region as well. But they also have the escalating wage rates, the skyrocketing debt, some currency fluctuations, and reshoring. In Europe, of course, they are bogged down with these issues of transformation of the economy and the Brexit, especially with respect to the negotiations with the British. And regionally, we are renegotiating some of the TPP. There's a lot of talk about economic integration issues. The Asian Development Bank, for example, in 2016 and early 2017, has put out a lot of documents and publicizing the work of the Asian Development Bank in the regional cooperation aspects and regional integration. I might also add that, pleasantly, the Institute of Southeast Asian Studies, the Yusof Ishak Institute, also in April 2017 came out with this focus issue called Southeast Asian SMEs and Regional Economic Integration. So the Institute itself has taken its task to look at all the issues regarding regional economic integration and also the SMEs. I could go on and on, but this is not my part to talk about these things. Besides, I think you also have to take with a pinch of salt. After all, people who know me, I'm an environmental economist. So what do I know much about the macro global economy? But with that, let me introduce the two speakers. We have an hour session. The speakers will speak for about 15 to 20 minutes, and then we'll open the floor for the Q&A. So let me start perhaps with the global economy. And here I point to actually a good friend of mine whom we first met at NUS over maybe 30 years ago, maybe 25 to 30 years ago, when I was still in NUS, and Razin Salih here, and he is now with the LKY school, the Lee Kuan Yew School. When I knew him, he was with the London School of Economics as well. He is presently chairman of the Institute of Policy Studies in his native Sri Lanka, and economic advisor to the Ministry of Finance of Sri Lanka. He is a member of the Legatium Institute Special Trade Commission, which advises the British government on Brexit issues and trade strategy. He has taught in many places, including serving in the Global Economy think tank at Brussels and so on. You have his bio in the pamphlet that is in your conference kit. So it tells you a little bit more of Professor Razin Salih's work. And I think we look forward to his work on Sri Lanka, which we published in 2018. So with that ado, let me pass on the mic to Razin to talk about the global trends.
Thank you.
Professor Razin.
Well, I'm going to talk about the global economic outlook for 2018, and with it the trade outlook. And then in my remaining time, talk a little bit about trade issues in particular, which is, if you like, my narrow area of specialization. So let me start with some very big picture comments on the world economy. Now, if we take a broad sweep of the last 10 years or so, since the onset of the global financial crisis, what we've seen is that growth in the developed countries has slowed down considerably, which is what happens, not just with an ordinary recession, but particularly with a financial recession, with a big overhang of government, corporate, and household debt. And after an initial burst of growth, we saw a big slowdown in emerging markets as well for a period of about 4 years, between 2012 and 2016. And that affected China, Brazil, Russia, India to some extent as well, although this is something perhaps Mano will talk about later, not particularly ASEAN, which has seen steady growth both before and after the global financial crisis. The big positive news for 2017 is that we've seen a pretty broad-based global economic recovery. And it seems to have gathered strength more than anticipated as we rolled through 2017. So the big question really for the outlook for this year is whether that recovery can be sustained. Now let me say something brief about the nature of this recovery that we've seen last year. It is broad-based for the first time since the global financial crisis, in the sense that we see a recovery in North America, in Europe, as well as a pickup in growth in East Asia in particular. And beyond that, it's even more broad-based in that we see a big pickup in manufacturing, in fixed investment, in business sentiment, as well as in consumer sentiment. Let me go through these slides from the IMF, the latest forecast, very quickly. As you see right at the top, the forecast for global growth increased from 2016 to 2017, 3.5% or thereabouts. We see growth actual and predicted of around the 2% mark for the United States and the euro area. We see higher growth in Japan, coming close to 2% last year, though whether that can be sustained remains to be seen. When we go down to look at emerging markets and developing economies, we see Russia and Brazil coming out of deep recessions, though still with very low rates of growth. We see developing Asia continuing to grow healthily, around the 6.5% mark, and that's reflected with growth rates of around 6.5 to 7% in China and India. ASEAN very steady, as it has been for some time, around the 5% mark. So that gives you an indication of a broad-based recovery. If you would just look at the trade numbers on the next slide, what it shows is a distinct pickup in the growth of international trade from 2016 to 2017. And that's something I'm going to come back to in a moment. So the big question, of course, to return to that big question, is can this recovery be sustained? Well, the signs, the short-term signs are pretty good, but let me point to some important warning signs. First, the macroeconomic fundamentals of the West in particular remain weak. On the fiscal side, with a big public debt overhang, particularly more so in many ways in the European Union than in the United States. Still a corporate debt overhang, more so in Europe than in the US. We see problems with the nature of monetary policy, given the reliance on quantitative easing over the last 10 years. And the move away from such cheap money policies with higher interest rates does pose risks not just in the West, but also for some of the more vulnerable developing economies. My own Sri Lanka, for example, which has pretty bad macroeconomic fundamentals, could be hit considerably with debt servicing if interest rates rise globally. Secondly, productivity. Now, long-term growth depends very much on improvements in productivity. And what a number of studies have shown over the last few years is that we have seen a pretty significant global productivity slowdown, and that continues. So that does raise big question marks about medium to longer term growth beyond the short term. And then the last warning sign, I think, is China in particular, and in particular the Chinese banking system. And given the explosion of credit in China, which goes beyond the official banking system to off-balance sheet mechanisms, are now estimated to be over 250% of GDP, overall credit in China. That just does raise a question about the sustainability of the banking system in China and what its repercussions might be for the wider region and indeed for the world. Now, of course, to some extent, that's cushioned by the fact that the Chinese banking system remains largely closed, particularly with capital account controls. But I just wanted to point out to those warning signs as to how a recovery might be derailed in one way or the other. But as I said, the short-term signs look not too bad. Let me now make some comments about broader economic globalization and trade in particular. Now, the big story is this. Since the global financial crisis, economic globalization has stalled but not reversed. So it's good news and bad news. And it's captured by this slide from the Peterson Institute, which shows that the big increase in global trade as a percentage of GDP, which hit about 60% 10 years ago, has pretty much plateaued over the following 10 years. So globalization, as that picture captures, has not reversed like it did in the 1930s, but it's stalled. It's not gone further. And let me now flesh out that story on international trade in particular. What we saw until 2016, in the 4 years up to 2016, was something quite unusual by post-war conditions. Before that, trade increased well above the rate of world GDP growth, which was a strong indication that trade led or was an engine of growth. That reversed after the GFC, and between 2012 and 2016, we saw the growth in international trade hardly keep up with global GDP growth. Now, the good news again in 2017 is that there's been a significant trade recovery alongside a global economic recovery, and trade has recovered to grow faster than overall world GDP growth. Again, the question, is this sustainable into 2018 and beyond? And my answer here is very similar to what it was with global macroeconomic conditions. What we've seen is a pickup in international trade as a result of a cyclical pickup in the world economy, particularly more fixed investment, higher manufacturing production, translating into more imports and exports, particularly through global supply chains, and also higher rates of growth in services. Now, if those warning signs become more pressing, if they go from green to amber to red, then of course that threatens a derailing of a global trade recovery. But so far, the news is good, particularly for trade-dependent economies such as we see in this part of the world. Let me point to one other thing which I think is very interesting. Even when global trade slowed down, the slowdown was most pronounced in manufacturing, and that, of course, hit manufacturing exports in this part of the world through global supply chains. But, and this is a significant but, global trade in services remained quite resilient and continued to grow faster than global GDP growth, even during the slowdown. And if you look at a couple of areas in particular, like ICT services and travel and tourism, they continued to grow healthily after the global financial crisis. And a final slide here, it's from a McKinsey Global Institute study of the digital economy. Their estimate, and these are guesstimates because it's difficult to measure precisely, is that even though overall world trade has slowed down since the GFC, what we've seen over the last decade or more is continued explosive growth in digital trade. Digital trade, whether it's actually embodied in goods and services, or whether it's standalone, like, for example, a Skype call, or whether it's in the form of e-commerce through Alibaba, eBay, and other platforms. Now, the broad lesson I would draw from these trends in services in particular is this. Whatever the cyclical patterns of international trade, the ups and downs in this year and beyond, what we can, I think, look forward to is higher rates of growth in services. Services trade embodied in manufacturing, in agro-processing, and standalone in services. And there's huge potential there, not least in this part of the world, but to unlock the potential and to make it grow faster does require the kind of reforms that can be quite complicated. And that gets us into quite difficult structural reforms, which I'll come to right as I close. Let me now move specifically to the trade policy picture, having said something about broad trade patterns. Again, the big picture since the global financial crisis is this. We haven't seen a big reversal into protectionism as we saw in the 1930s or even in the 1970s. And we have global supply chains, in the first instance, to thank for that. But what we have seen is an increase in what trade economists call creeping protectionism. An increase not so much in tariffs, but in non-tariff barriers, like standards regulations, public procurement restrictions, subsidies, anti-dumping duties, and so on. But so far, the effect of this creeping protectionism has been relatively modest. And global supply chains, which are the real drivers of productivity and employment and growth in international trade, have remained largely intact. However, as you all know, in the last couple of years, we have seen an anti-globalization backlash, not in the rest, but in the West. So far, it's not affected the developing world, because the developing world, particularly in Asia, continues to see the benefit from globalization in a very broad-based way. However, in the West, although the aggregate numbers show that the West has also benefited considerably from globalization, from the increasing specialization we have in the world, we have, of course, pockets of discontent. But that has to be differentiated. In Europe, the discontent, although yes, there are grumpy noises about trade, that comes particularly from the French, surprise, surprise. On the whole, the backlash against globalization is a backlash against immigration. In the United States, the backlash is a combination of immigration and trade. And we see that embodied in President Trump and his announcements. On trade, the backlash comes from pockets of manufacturing that seem to have suffered from Chinese competition in particular, although the reasons for this are manifold and complicated. A lot of it has to do with technology and not directly to do with trade. But there has been a backlash nonetheless. And what we have now in the United States is a president who is more isolationist and protectionist by instinct than probably any since Herbert Hoover in the 1920s and early 1930s. And of course, Mr. Trump and his trade policy team, which is also the most protectionist trade policy team the United States has seen in a long time, have made very threatening noises on NAFTA, on China, on the WTO, and other trade issues besides, with a very mercantilist obsession with trade deficits. Now, so far, the bark has been worse than the bite, and we haven't seen big protectionist measures come through. What I would like to do is just point out very briefly two big scenarios, a negative one and a positive one. The negative one is this, that the bark will translate into bite in 2018 and beyond. Possibly the breakup of NAFTA, possibly a complete disruption of WTO dispute settlement because there won't be a quorum of judges on the appellate body because of US blockage. Possibly much more protectionism against China through anti-dumping duties and other things, all of which might translate into tit-for-tat retaliation, starting perhaps with the Chinese, the Europeans, and then the middle powers. And that, of course, if that scenario does materialize, it does threaten the considerable weakening and possibly the breakup of the kind of post-1945 trade governance we've had. The more optimistic scenario, which is still not very optimistic, but perhaps realistically optimistic, is that the bark will remain bark and will not translate into much bite in 2018 and beyond, because there are significant countervailing forces, pro-globalization forces, not just outside the United States, but within the United States, beginning with big American companies very much intertwined in global supply chains, translating into votes and actions in Congress, particularly in the Republican Party and in the states. So far, that's contained the Trump protectionist phenomenon. I am guardedly optimistic that it will continue to be contained, although I think there are still some significant protectionist measures in the pipeline. Hopefully not the measures that I mentioned in the negative scenario, but some, but not enough perhaps to derail international trade and global growth in a really apocalyptic way. Very final comment on trade. Houston, do I have another few minutes?
Yes.
Thank you. And that's on so-called mega-regional trade agreements. Now, as you know, over the last 15 to 20 years, we've seen a proliferation of free trade agreements around the world. Singapore, of course, started the process with the Singapore-US FTA. But the news in the last 4 or 5 years has been very much of trying to package these agreements into bigger so-called mega-regionals that would have a bigger impact on the world economy. There are 3 in particular. The Transatlantic Initiative, which is stalled for the moment, and then 2 in this part of the world, which are very important, the TPP and RCEP. And let me say something briefly about both. Now, in my view, as someone who is a card-carrying free trader, the TPP, for all its faults, inevitable given the number of countries involved and political reality, is the most positive and most significant trade agreement since the end of the Uruguay round and China's accession to the WTO. It's not only broad, it's also deep. I won't go into the detail here. But the TPP, if implemented, and with the United States on board, would make a big and positive difference to the world economy, and particularly to the world of global supply chains. Now, with the United States involved, it's about, what is it, a third of global GDP and a quarter of world trade. However, the US has exited, very unfortunate, that is a big strategic blunder, and the TPP minus the United States shrinks to just over 10% of world GDP and about 15% of world trade. Now, the latest development is that the TPP 11, minus the United States, have agreed on a framework agreement. There are still some hitches, but the chances are it will go ahead and it will be implemented in 2018 if some Canadian objections can be overcome. The good news is that the original agreement remains 95% intact. There have just been a few minor revisions which have been suspended pending the United States remaining outside. So if that's implemented, I think it will be good news on 2 fronts. Firstly, we will have a strong trade agreement going ahead, even without the United States. And secondly, it'll be an agreement that will remain ready and fit for the United States to join or rejoin when political conditions are ripe in Washington. The other major agreement, of course, is the Regional Comprehensive Economic Partnership involving China and India. That's why it's almost half the world's population, about 30% of GDP, and about 25% of world trade. It's a very different kind of agreement. By and large, it's good that this is being negotiated, but the eventual agreement, if it is agreed, will be much weaker than the TPP. It'll broadly be an intra-Asian type FTA which will reduce and remove most tariffs eventually, but not really tackle the non-tariff and regulatory barriers that are the much bigger obstacles to international trade. So it will have a lesser impact on global supply chains. However, the important thing to bear in mind, since the United States has left the field open for China to take the initiative on trade in this part of the world, is a combination of trade and infrastructure. It's a combination of RCEP and the Chinese Belt and Road Initiative. And of course, infrastructure cross-border is very much about trade. Now, I have more doubts than the conventional wisdom has it on Belt and Road, as I do about RCEP, and indeed about Chinese economic policy and the future of China more generally, but that goes way beyond our panel. But this is important to bear in mind. The point I want to make here for countries in the region is that while it's important to be involved in these Chinese initiatives, it is as important, and perhaps more important, to be involved in, shall we say, more ambitious, pro-market, pro-trade, and pro-globalization initiatives such as the TPP or the CPTPP. And eventually, of course, to bring the United States back to the table. So, concluding comments, looking to economic policy in Asia-Pacific this year and beyond, we are in a region with reasonable macroeconomic stability on fiscal, monetary, and exchange rate fronts. Of course, big differences as between countries and sub-regions within the overall region, but the picture looks a lot better, particularly in terms of averting future crisis than it did before the Asian crisis and the global financial crisis, and the quality of regulation in central banks and finance ministries is also a lot better. We have lagging financial sector reforms. This is particularly important for middle and high-income countries who need more sophisticated financial systems rather than financial systems that are state-directed and rely on bank credit. And many countries have difficulties bringing about these kinds of financial reforms because it does mean more markets and more competition. The biggest offender is China. China, again, is the biggest offender when it comes to a kind of picking winners type of industrial policy. There's a huge experiment going on in China in the midst of its market economy, whereby the state is actually picking sectors and indeed individual firms with huge subsidies and not insignificant protection. We'll see if that works. I have my doubts. We have reasonable incremental progress in removing a lot of red tape around the region. India and Indonesia, for example, have raced up the rankings in the World Bank's Doing Business Index. There's still a lot more work to be done there. But I think the biggest problem this part of the world faces is the lack of what economists call structural reforms that go beyond some of the basics on all sorts of things, which essentially prevent upper middle income and high income countries from improving their productivity. And of course, the important thing on trade, to reinforce a point I made earlier, is to contain the kind of protectionism that might be in the pipeline from the anti-globalization backlash in the West, and find ways to accelerate liberalization through mechanisms such as the TPP. Thank you.
Thank you very much, Professor Sali. We'll hold the questions to the end, so we'll introduce the second speaker. Second speaker, Manu Bhaskaran, is a familiar face to all of us. He's a partner of the Centennial Group, which is based in Washington, and he founded and he was the CEO of the Centennial Group, Singapore subsidiary in Asia. He also is very active, not just in the financial advising, the practical front, but also in the academic front. As many of you would know that he does a lot of writing, and he is immensely important and very useful, very relevant to the Economic Society of Singapore as a vice president, which he served with great distinction. He does a lot of, he sits on the boards of the Asia Foundation, member of the Competition Appeals Board, and he has degrees from Cambridge as well as Harvard. And you can read more about his bio of Manu in the pamphlet. So we're going to move from the trends, the global trends, to focus on the regional trends and more the ASEAN Asia. So with that, Manu, please.
Thank you, Houston, for that very kind introduction, and my thanks also go to the organizers for inviting me to speak. Economics is supposed to be a dismal science, but I have good news for you today. And my sense is that the global economy, I think, will continue to surprise on the upside, at least for the next year or so. So basically what I'm going to say is to take up from a lot of the points that Razin introduced and to apply them to our part of the world. And essentially, I think the stars are aligned for ASEAN this year to enjoy a very strong pickup, probably the strongest in several years. So first, just to introduce the points I want to raise, I think first the uplift that we get from global demand will continue to propel the things that matter for us, which is our manufactured exports as well as the prices of commodities that matter for us. Secondly, in addition to the pickup in exports, we are also seeing some of the domestic drivers within these economies picking up. So altogether, it is a positive story of broad-based pickup, which should be resilient, which should make us resilient to some of the downside risks that certainly do exist in the world economy. I will then talk about Indonesia and Malaysia. Both are enjoying, in different ways, the benefits of a global pickup, but probably Malaysia much more than Indonesia. Having said that, I do think that Indonesia is putting behind it the last 2 years of fairly lackluster growth. Of course, there are many risks: geopolitics, financial dislocation, and the threats to the global trade regime, which Razin very ably mentioned, which I think are the single most important risk that ASEAN, as a trade-dependent region, faces. So let me expand on some of these issues, starting with the impact of global and cross-regional factors. As far as the global economy is concerned, the lead indicators are very positive and suggest further growth. Within this, we look at lead indicators like the OECD lead indicator, which suggests that developed economies, as well as the large developing economies, will continue to enjoy a rebound. We have other data such as new orders, particularly new export orders, which tell us about the implications of global recovery for trade. And trade is very important for us. All these things look very positive. It's also interesting to try and understand what are the underlying processes within this global recovery, because it is these that will matter for our part of the world. And I think what we're seeing is that the overhang of despondency post the financial crisis is over. And we are now seeing a return, a kind of normalization of the G3 economy. So basically, the credit market, the housing market, the labor markets that were damaged by the crisis are sort of returning to normal. And some of the normal relationships between global trade and global growth, for instance, I think are coming back. And that's very good for this part of the world. There are some concerns about China, but large emerging economies, India, Indonesia, Brazil, Turkey, Russia, now make up about 20% of the world economy. And this 20% is enjoying a rebound. That is very good. Now, what is very important for exports from this region, particularly manufactured exports, are the capital spending decisions of companies in developed economies, particularly the US. And this has been the missing ingredient in the global recovery for a long time, and that explains why the export benefits to this part of the world were long in coming. Now we are seeing a pickup in capital spending. It's still a bit tentative, but it seems to be gathering strength. And what is also quite interesting is that imports of capital goods within Asia are recovering. That suggests that a new investment upcycle is beginning to take hold even within Asia. Now, if capital spending recovers with all its tremendous multiplier effects, that is very positive for the recovery in the economy to continue across the world, but it is also very important because capital spending tends to be very import-intensive and is the single most important driver of manufactured exports from Southeast Asia. So, again, the forces at work appear very positive for export-oriented economies in Asia. So here are a few charts just to show OECD lead indicators up, new business orders received by companies across the world accelerating. A lot of it is new export orders, and you can see in the last chart, bottom right, how US new orders for electronic components accelerating very dramatically, very positive for us. Now, what does this mean for Southeast Asia? Well, first of all, clearly, the demand for manufactured exports, particularly electronics, will continue to strengthen, and the winners from this are clearly Singapore, Malaysia, Thailand, and to some extent, the Philippines. The rising capital spending cycle is going to further boost manufactured exports. Secondly, commodity demand and commodity prices, which are already at multi-year highs, should persist. Oil prices have risen. That is very positive for Malaysia, for the ringgit, for the fiscal position. It is not so positive for the rest of us, but I would argue that even at the elevated levels we see today for oil prices, we are still in a kind of sweet spot for oil prices, where oil prices are high enough for the oil producers to continue spending on capital equipment and so on, but low enough so that the oil-consuming nations are not so burdened by high costs. So I think we're still okay for now. Tourist arrivals, another dimension of the world economy, have been picking up steam, and that's also very positive for ASEAN. We are seeing rising business confidence across the world, beginning to boost foreign direct investment, another important driver of ASEAN's growth. And we shouldn't forget the remittance income, which is very important for countries like the Philippines, which have proved to be quite resilient and which are showing signs of picking up as well. Financial markets, asset prices and so on are still powering ahead. Not sure how long that'll last, but for now, financial conditions are very supportive of growth. What about the domestic drivers? I think if you look back the last few years, we had a succession of unfortunate events. We had bad weather in some countries that hit agricultural output and rural incomes. We had the introduction of necessary reforms, such as the goods and services tax in Malaysia, subsidy rationalization in Indonesia and Malaysia. These are things that are clearly necessary and good for the long term, but which had initially negative impacts. Now, the good news is that a lot of these one-off negatives are dissipating and giving way to more positive forces. So that alone results in some growth. Secondly, we are seeing more spillovers from the export sector into other areas like port services, airport services, and as the employment impact of the world recovery broadens out, you get more jobs, more wage increases, more overtime, and that translates into rising consumer confidence. Then you have the lagged effect of policy easing, particularly in Indonesia, where rates have been cut several times in the last 18 months. And finally, you have the beneficial impact of supply-side reforms. Razin quite rightly pointed to some of the really dramatic improvements in rankings for Indonesia, for instance, in the World Bank's Ease of Doing Business rankings. And I think that will continue to have a positive impact on the business environment, encouraging businesses to invest. So these are just some data points to make the point about improvements in the structural side. I talked about the new investment cycle, and you can see from the chart how capital goods imports are beginning a more positive outlook. I think this is going to accelerate. First of all, we have a big infrastructure push across the region. We have build in the Philippines. We have the mega transportation projects being expedited in Thailand, as well as the very ambitious Eastern Economic Corridor projects. All that is not just being talked about anymore. The contracts have been awarded, and activity will accelerate very soon. And then you have the Belt and Road projects. Now, I share with Razin some of the longer-term concerns about the way the Belt and Road projects are being implemented. But certainly in the short term, this acceleration in investment spending is going to boost economic growth pretty much across Southeast Asia, but particularly probably in the Mekong region and in Malaysia. There will also be further effects of this pickup in investment. When public sector investment accelerates and creates potential new business, the private sector tends to get interested and is incentivized to also increase their own investment. So private investment tends to be crowded in, and we're beginning to see signs of this as well. So again, a very good and positive outlook. Now, what are the risks that will be relevant to this part of the world? One clearly is we are going to see global monetary tightening really begin to impinge on financial markets. By about the middle of this year or the third quarter of this year, central bank purchasing of bonds will turn negative for the first time in many years. That's an important inflection point. And as you can see from the top left-hand chart, my measure of global excess liquidity, that is the liquidity over and above what the real economy needs, that is beginning almost about to contract. That is always a bad sign for financial markets. So all of you rushing to buy Bitcoins, please take note. And as I said, financial dislocation, I think, is a clear concern. We may not go back to the taper tantrums of 2013, where we saw outsized currency depreciation and so on, because I think at that point in time, in terms of the region's fundamentals, like current account deficits and policy credibility, I think we had some problems. But we have improved since then. So I think while there will almost certainly be some degree of financial market turbulence, some degree of hit to our local currencies, I don't think it will be as serious as it was in 2013. There will be all kinds of unexpected surprises in the global economy and in geopolitics. That is a fact of the lives that we lead today. So the real question is not whether we are invulnerable to these shocks, but how resilient we are to those shocks. Can we absorb these shocks and bounce back? And we have a measure of this capacity to absorb a shock and bounce back, which we call the resilience index. And what this shows, to summarize, is that over time, virtually all Southeast Asian countries, the possible exception of Vietnam, have improved their fundamentals, their economic diversification, the credibility of their monetary policy and their central bank, the way they manage their exchange rates, and the supervision of banking sector, which results in stronger balance sheets. All these things have produced greater resilience. So I am sure over the course of the next 12 months, even with my positive outlook on activity, on growth, there are bound to be some important shocks, whether it's financial or political or whatever. But the good news is I think we are in a position to absorb these shocks and keep coming back. And that, I think, is good news. Let me move on now very quickly, in the short time I have, to look at some of the countries that I've been asked to review, starting with Indonesia. As I mentioned earlier, Indonesia has had a difficult few years, and economic growth has been disappointing, less than the 7% that President Joko Widodo wants to see. But what we are now beginning to see is the early signs of a strengthening. The lead indicator that the OECD has for Indonesia is looking up. Industrial production and some of the other high-frequency economic data for activity also beginning to look up. Capital goods imports are rising, and that suggests that domestic businesses are indeed expanding capacity. That's always a good sign because those companies know what they're doing, they can see the flow of business, and they clearly see something positive, and that makes them willing to take the risk of growing capacity. Tourist arrivals have been strong and in fact quite resilient, even despite the volcanic activity in Bali, which scared off a lot of tourists. In terms of stability indicators, Indonesia is having some of its best inflation outcomes for a very long period of time. And I think that can reflect some very fundamental and structural improvements in Indonesia's ability to manage monetary policy, and it's the increasing credibility of Bank Indonesia. As a result, the Indonesian rupiah has been remarkably stable and foreign exchange reserves have been rising, and that again gives Indonesia resilience. So here's just some charts to make the points that I mentioned. If you look at the bottom left chart, real investment growth has been picking up, and I think that is a positive sign in particular. Consumer confidence has recovered from the shocks of the subsidy rationalization, and I think we should see a pickup from now on. And in terms of the trade drivers, in terms of the inflation outcomes, in terms of international reserves, all looking very good. The question then is, is this just a cyclical bounce that won't last very long, or is it more than that? I would argue there are some important structural improvements. First of all, there are signs of better fiscal management. For the first time, we've got tax revenue that reached more than 90% of the budgeted targets, and spending also at 94% is an improvement. The quality of spending is also improving, although slowly, as a result of the reforms that President Joko Widodo has brought. And it really does serve to remind us that effective and quality leadership in economic policy does have a very important impact, even though it might take time to come through. President Joko Widodo's continuous pressing for deregulation has resulted in a really dramatic improvement in the business environment. Indonesia used to rank 120th in the ease of doing business in 2014 when the president was elected, and that has moved to 72nd position. That's not easy to achieve, but he has achieved it. And his target is to get Indonesia to the top, within the top 50 in the next year or two, and I think it can be achieved. I mentioned that inflation management has improved, and that has also been reflected in ratings upgrades by several rating agencies in the last 12 months. The disappointment remains in infrastructure, but even here we are beginning to see signs of improvement. Large-scale mega projects prove very hard to be launched, but there is a proliferation of small-scale projects in power, in ports, and in roads that are going ahead and which have positive impacts. And we've seen that in little things like the Jakarta Airport link and also how the mass rapid transit project is taking shape. But it's not out of the woods yet. There are some challenges that Indonesia will have to face this year. Even though management of the external dimension of the economy has improved and inflation has improved, the Indonesian rupiah, I suspect, might still come under pressure simply because of the financial dislocation risks in the global economy, and because foreign ownership of bonds and equities in Indonesia is at a record high. If you get an abrupt recalibration of risk appetites among global investors, and these things happen very often in the world economy today, then you could get downward pressures on the currency. So there is still a way to go in terms of managing these external risks. The longer term question is, can Indonesia go beyond what I call lazy growth? I mean, Indonesia should be growing rapidly anyway because it has such favorable demographics, there's urbanization, it has tremendous resources and all that. Even, without doing too much, you will get 5% growth. But that's not enough. Indonesia needs to grow much faster if it is to deliver much wider welfare benefits to a broader swathe of its people. It needs to generate that kind of growth if it wants to generate formal sector employment, where workers get access to income-earning opportunities in a protected environment so that the quality of their lives is so much better. And here, I think there still is a lot of work to be done. The business environment has improved, but, companies doing business in Indonesia will tell you that they still face difficulties. On the fiscal side, there is still an urgent need to widen the tax base, and things like the tax amnesty have helped, but not enough. In the labor market, rigidity still exists because of the kind of regulation and laws that they have, and that is one reason why Indonesia has missed out on this historic opportunity that only comes once in multiple generations. As companies relocate activity out of higher cost China, Indonesia has not been the main beneficiary. It should have been. It is a great loss of opportunity. The trade regime still needs to be reformed so that it can promote competition and allow companies to gain scale and efficiency improvements. So the result really is, I think, self-created hindrances to growth that hurt workers' welfare and the people's welfare. And that's manifested in things like, you see a rise in foreign investment, but the foreign investment is not going into export-orientated manufacturing, which is where the real efficiency gains could come. And growth is not generating sufficiently formal sector employment growth. So there's still work to be done, but generally, I think we should see Indonesia on a much better track, not just cyclically, but I think structurally as well. Let me move on to look at Malaysia. And Malaysia is really in a very sweet spot right now. It's enjoying an acceleration in growth, and all the stability indicators, inflation, current account, the currency, all look reasonably good. After the city-state economies of Hong Kong and Singapore, Malaysia is probably the most open economy in the world. So it is not surprising that a pickup in the global cycle would benefit this economy much more than other of its peer economies. So we've seen export growth rising, and that spilling over into other economic activity indicators. Business confidence has risen, capital goods imports are rising steadily, and Malaysia, as I said, is a beneficiary from the rally in oil prices. Inflation has been managed reasonably well, and the ringgit, after suffering serious depreciation, has now recovered significantly, while still retaining the competitiveness gains it secured during the period of depreciation. So the cycle is strong. You can see the top left-hand chart how the lead indicator is accelerating. You can see the dramatic improvement in business confidence, and consumer confidence, however, is only just beginning a tentative recovery. So that has been a bit slow in coming, and that could have other consequences as well. But in terms of stability indicators, I think we have to say this is a well-managed economy. What about the long-term potential? Of course, when you talk about Malaysia, and there will be a lot more on Malaysian politics later, we need the qualification, barring political mishaps. I think this is a upper middle income country that can still generate reasonably good growth for its peer group. Don't forget, Malaysia still remains a competitive economy. It has globally competitive clusters of manufacturing activity in the Iskandar region and in the Penang-Kulim corridor. The ringgit, as I said, is still very competitive, and simply because Malaysia is next door to higher cost Singapore, there is a constant flow of relocation of activities from Singapore, which will benefit Malaysia. The government, through the Economic Transformation Program, I think has also added to long-term growth potential. And one of the great successes is that the improvements and reforms that came through in the last few years have encouraged private sector investment. So private investment as a share of GDP has improved significantly in the last few years. And now we have another factor, which is Chinese investments. Now, there are quite a number of port and other transportation projects that are already being implemented and more coming through. Chinese investors, both state-led as well as private sector investors, like Malaysia for its low cost and proximity to Singapore. So I think this will be a positive for the next couple of years. Now, my concern is the nature of some of these projects, particularly the port projects, which do not appear to be viable to me in the long term, and which could saddle Malaysia with high debt and assets that are not very productive. So that has to be watched very carefully. Other elements of Malaysia's competitive positioning for the long term, I think there's some warning signs. Malaysia was doing very well in the World Bank Ease of Doing Business report, but it has really suffered a huge fall, falling from 6th to 24th in the global rankings. Other measures of global competitiveness, like the IMD index, also show Malaysia beginning to again lose competitiveness. So the problem is that other countries are doing their best to improve their supply side, and if Malaysia does not match them, then its relative positioning tends to fall. So I think with that warning, I think Malaysia is okay in a cyclical sense. Long term, I think it depends on more policy reforms to maintain that competitiveness. Overall, I think what I've described is a fairly positive outlook for Southeast Asia as a result of the global recovery and as well as domestic forces. And I think we should look forward to a pretty good 2018. Thank you.
Thank you. Well, there you are. We have two speakers who are generally very upbeat, both the global economy as well as the regional economy. Seems very positive. Later on, we'll ask them about how confident are they in their prediction and their analysis. Just to recap, and then I'll open the floor to questions. One is, Razin Salih has talked about the positive global growth covering US, Europe, and many of the developed economies, as well as emerging economies and Asia. He questioned whether this growth can be sustained. He cautions us there are some warning signs, such as the productivity issue, the Chinese banking system, the explosion of the money credit. He compared the growth in manufacturing with the growth in services, and the growth of talked about the growth of the digital trade. He warned about the return to trade protectionism, but he thinks this impact is still quite small. He talked about the TPP and the RCEP, but he's not worried about, or terribly worried about the US not joining the TPP at this stage, and he talked about the possibility of the US returning to the TPP in the future. He mentioned that the most important message is that we should be pro-market, pro-trade, and concluded that there is macro stability, but relatively needing more, for example, more financial reforms. In the case of Manu Bhaskaran, he's also positive on the global economy, on the global economy impacting Asia and on Southeast Asia. There are strong signs of recovery in the capital spending, and he talked about the domestic engines of growth that have contributed to Southeast Asia's economic growth and recovery. The domestic consumption, for example, is strong. The infrastructure spending fueling that growth. He warns us, however, about some important risks, and he mentioned 3 risks. One is the geopolitical risk, and in particular, what's going to happen to the Korean Peninsula, and the Middle East conundrum, oil prices, question mark, and the financial risks. And the 5th thing he talked about was the regional economies, going to Indonesia in detail, and Malaysia, but his prospects for both economies, despite their problems and so on, is actually quite good. He ended off by talking about he questioned whether there is regional resilience. Have we built up enough regional resilience to take these changes and these shocks and transformation? And his answer was basically yes, much better than before. There were much more reforms that have taken place. And I think the conclusion is that there are still lots of potential growth which is yet to be untapped, but depending on whether these reforms are done well and smooth. Okay, so these are the 2 main messages, I think, messages from the 2 main speakers. So I open the floor now. I have questions, but I think we would like to hear from the floor, more important than hearing from me. So the mic is there. Just identify yourself and ask the questions. Anyone? Not going once, going twice? Okay, so let me ask the question then. Then maybe you warm up and you can ask one question. I think this can apply to both speakers. This has to do with when I opened this introduction, I talked about the tax cuts in the US. That's quite substantial and it's quite impactful. It's also a very pro-business tax. And one, if I can remember, there's a tax cut from 35% down to 21%, and business capital expensing as well. Coupled with the increases in interest rates, then how will this impact the region? Will there be, can we comment more about there's always this talk about capital flow back to the US. Is it for real? Is it happening? What about the reshuffling in the global value chain? And the second thing I want to ask is that the US seems to balk when it comes to sustainable development. It seems to be decreasing its focus on green industries and relaxing environmental regulations of late. Now, how does this impact the region? What's happening in the US is going to, in terms of reducing its commitment to green industries and green growth, how does it affect Asia or ASEAN? Is Southeast Asia capitalizing on this? What can we do to capitalize on this, basically? Okay, cheers. Anyone? Yeah, Manu?
Let me try that. First of all, in terms of the US tax cuts, there's still a bit of a debate on the short-term impact. Some argue that the way the tax cuts are structured, there will not be that much of an improvement in, further improvement in capital spending, for instance. But there's no doubt that the fiscal position will be easier and will boost growth by at least 0.2 to 0.3 percentage points of GDP, and that should be positive for this part of the world. The longer-term consequences are a bit more questionable. If we follow historical experience of how American politics and indeed politics everywhere else works, it's very easy to cut taxes. It's very difficult to bring spending under control. I suspect that the fiscal deficit will be much, much worse than projected. And that could lead to the twin deficit problem in the US, current account deficit and budget deficit, that we saw in the 1980s coming again. And that could be destabilizing for the world economy with consequences for currencies and so on. The second implication is there is a considerable amount of corporate cash that's been kept in Hong Kong and Singapore. There are strong incentives for some of this cash to be repatriated. So yes, I think you will see capital outflow from the money center areas, but I don't think there'll be a huge impact because a lot of this cash is kept in US dollars, not in local currency, so there will not be much in terms of a currency impact. In terms of the Trump administration's policies on sustainable development, renewables, and so on, I think this region responds not so much to the US, but to the entire global picture. And here the US is out on a limb. I think other large economies continue on that path to a sustainable development. And I think the US policies, while not positive, will matter less these days, given the commitment, the very strong commitment of China, of the European Union, of Japan, and so on, to these policies.
I agree with Manu wholeheartedly on the first point on the implications of US tax reform, but I'll take a slightly different tack on sustainable development. On the US tax reform package, I'm uneasy about it. I wish it were more like the Reagan tax reform package of 1986, which was more broad-based. It was not only about corporate tax reform, but also about individual tax reform. And it had less worrying implications for the fisc, for fiscal deficits and overall levels of debt in the future. And finally, politically, not least, it was bipartisan. Ronald Reagan did it with the support of at least elements of the Democrats. The political basis of this tax reform package is questionable because it's been rammed through by a Republican majority, and it only increases the divisions, the polarization we see in the United States. It's fiscally very questionable because it will increase deficits considerably and the overall US debt burden and debt servicing. So any fiscal conservative should be worried about this tax reform package. And finally, though it does many of the right things on corporate tax reform, it doesn't do enough of the right things on individual tax reform. So in that sense, it's rather lopsided. Those are some of the internal aspects of US tax reform. I think I agree with Manu's assessment of both short-term and longer-term implications for the rest of the world. On sustainable development, let me take a little different tack that is a little different. I didn't agree with much of what President Obama did on his so-called green agenda. A lot of it was about increasing the discretionary power of the Environmental Protection Agency, or pushing things through subsidies and mandates, including subsidies for renewables, and of saying all the right politically correct things on the global environmental agenda, including the Paris Agreement. On the domestic side of things, I think some of what this administration is doing is actually right. So it is lessening the discretion of the EPA to introduce new regulations without appropriate checks and balances, without appropriate due process, and that means going through the legislative process. That, I think, is more positive than negative. I would echo Michael Green's doubts about the way the United States has exited from the Paris Agreement, but I would also echo his skepticism about the content of the Paris Agreement and what it might do to address global climate change. So I think we see a necessary Republican correction with this administration to the excesses of the green agenda of the previous Democrat administration, both domestically and externally. Let me also voice some doubts about the Chinese agenda on renewables in particular. And this gets back to one brief comment I made about industrial policy in China. Now, one important pillar of Chinese industrial policy, which covers a whole swathe of industries, is about providing huge subsidies, supported by favorable regulations, and indeed some external protection, to certain industries, like wind and solar, with the hope that China will soon have world-beating firms and conquer world markets in these areas. Now, I'm all in favor of moving to more efficient ways
of producing things that will have positive environmental effects. What concerns me is the way this is being done through industrial policy measures that might have very distortive effects on markets and might also increase trade protectionism.
Okay, thank you. I think we would have to close because of to allow time for the third session. One of the greatest challenge, I think, in Asia and also regional Asia is that we all want growth. We all want to catch up. We want to be like a developed world. There's this tension between having more growth and meeting environmental obligations, and how best to meet those environmental obligations in such a way that we balance the cost and the benefits. And that is the greatest difficulty and dilemma that most of the Asian governments face. So with that, but I want to say that economists are not engineers, they are not medical doctors, so they cannot be sued if the predictions are different, if it turns out differently. And economists are famous for, and they have displayed this wonderfully. On the one hand, we have lots of all these good things. On the other hand, there are all these worries and risks. So thank you very much. Thank you, speakers. Thank you, gentlemen. Thank you.